Welcome everyone to the Kendall Report, where I share my 43 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's videos, folks, I'm going to talk about something that seems to be somewhat taboo. Just about everyone thinks there's going to be a recession. There's a big decline coming into markets. I'm going to discuss an entirely different viewpoint of what's going on. Let's get into tonight's video. Welcome, folks. It's amazing to me as I look around the internet, Twitter, YouTube, everybody is expecting a recession and everybody is expecting a major decline in the markets. It appears that nobody was paying attention last year when the markets were declining and the rally back in the fourth quarter. The other thing that everyone's talking about is the inverted yield curve. And somehow this is the magic silver bullet that kills every economy, kills every market, and we absolutely have to have a major decline or this would break the rule of law. Well, this is not the case at all. Just because the inversion is there does not mean that we're going to have a major recession. I know it's the talk of the town, but this is really just amazing. If you don't think I'm right, ask Jim Cramer. My case is a little bit different. I don't think inflation is over. In fact, I think we're going to see inflation stay above 3%, probably 4% going forward. I believe the markets are going to start to adjust to this, and this will be the key element that you'll start to see evolve. Everyone's talking about we need to go back to normal. If you look back in the last 14 years since the GFC, nothing about that was normal. Zero interest rates are not normal. What's normal is a range where we are right now. I believe that's what we'll continue to see as we go forward. I don't see us going back and the Fed pivoting. Just because everyone thinks that's what's going to happen, that doesn't appear will be at all close to the reality. As I've been telling you for a while, the Fed is not going to pivot. They're going to continue with this story. I think even looking toward future Fed chairmen, they're not going to go back to this posturing of every time there's a problem that they just throw money at the situation and bail out everything. I think we need to rebuild the economy in a much different way. Now, I'm going to reflect this maybe even going back to the 70s. And the 70s were an interesting time, and more of the, say, 1976 to 1979. In 1979, inflation got out of control. Of course, we went to 16, 20% interest rates. That's not what I'm talking about. I'm talking more about a 4 to 7% range of interest rates, mortgages being in that range. There's absolutely no problem running an economy in that environment. The forward-looking costs and estimations of future value, yes, all that changes. We just aren't going to see what we've been watching over the last 14 years with zero interest rates. It's just going to be much different. And I think the entire economy is going to be restructured. Now, I don't have an exact idea of what that's going to look like, but I'm developing these ideas. I've been doing some research over the last several days, and it's becoming obvious that it's not just a contrarian view. It's just almost impossible for these things that people are talking about to occur. So I'll be on record here as being a contrarian. Now, one of the other things that I'll talk about even more here in tonight's video is the Wavetech database. The Wavetech database I mentioned in last night's video is nowhere near or configured how it looks before a major collapse is about to happen. That is not at all what's going on. The database reflects something much different, the beginning of new trends. Everything starts to look a bit different when the bottoming process happens. I went through some long-term charts last night, and if you recall, looking at the monthly charts are putting in a major bottom. Now, I mentioned also I don't expect an all-time new high anytime soon, but I do expect a positive rotation or a positive move in the markets, probably going through Q2, maybe bleeding a little bit into Q3. We'll see how this thing develops over the next couple months to see if this is the correct view as the markets start to unfold. Hopefully we'll see the database get over 62% on the intermediate, and we'll start to move this whole process forward. So this will be a theme that I'll be talking about from time to time. Let's go ahead and get into technicals and see how this thing is set up. And once again, I'm just going to be covering the S&P tonight. I will do a full live stream tomorrow night. I'll get a chance to cover all the markets at that time. Thanks again. Let's get into the rest of the video. We'll start with the hourly chart on the S&P tonight. A couple of interesting features here. We're seeing the algo starting to stabilize on PPM1. PPM2 is suggesting that we're going to see some bleed off of the uptrend, but it's very substantial. Right now, PPM2 is at a 1.41, and what that means is there's literally only a 10% probability for the market to decline below the 21-period moving average, which is right now 39.93. You'll see as I go through the presentation here that there's a number of support levels around the 39.90 level. So I do expect to see a little bit of weakness, but nothing major. We could trade as low as 39.70, 39.50. Let's take a look at the daily charts here. Daily charts, we saw a couple things really interesting. The upward fib targets right now are at 40.16, 40.59. They've been basically satisfied in this pattern so far. I'll show you here in a minute on TradeStation a couple other elements, and there is some new projected highs here in the pattern from that standpoint. But as we look at the algos here, as I mentioned, it looks like a couple of days down, but what's happening with the PPM2, that is continuing to expand a little bit. We're not quite in trend mode there, but we are seeing the value of the 21-day moving average starting to come up. It's currently 39.01. 39.69 maps out really good with that 40-hour moving average I just talked about. And we should see support between 39.60, 39.50. We could see a little print down. The key number is going to be that 40.52 number, which is the weekly, one of the weekly key numbers on the market grid for the weekly. Let's go ahead and take a look at the weekly patterns here on the S&P. We're seeing we look at the market grid, 39.91 is S1. As we look at the market grid here, S1, 39.58. Those are numbers I just talked about. We've had a low so far this week of 39.80. Could see a lower low in this pattern and still be in the support range. We're also seeing the possibility that we're challenging the R2 level again, which is 40.52. We saw a print up at the end of today's range, setting up right into 40.41. We're down 17 handles as I speak. So we're still looking at some choppiness with some little bias to the downside, as the algos were pointing out on the daily chart. But on the weekly here, if we get above this 40.52, there's some pretty decent numbers here for a move up to the R3 levels, 40.85, and we start to look at some of these other numbers. I'm going to go back to the daily here on TradeStation, and you'll see a couple other targets out here. We're looking at high target 2, 41.13, 41.68. Those numbers are still very valid, and the configuration here on the PPMs are suggesting that we will see that over the next, we'll say, 5 to 8 days. We should continue to see a positive tone. There is some potential, like I said, down to 39.60, 39.40 is the extreme range. So this will be the end of the video tonight. Thank you for watching. We'll see you on the live stream tomorrow at 9 p.m. Eastern time, just like the old days. See you then.